Thank you, Mr. Chair. In a number of the hearings I've attended, I've noticed that when the subject is an environmental, public health, or consumer regulatory issue, there are a number of questions about the estimates of the costs and benefits of the policy in question, and that's fine. Those questions explore the assumptions made in the analyses, the relative uncertainty or certainty of the estimates, and how sensitive the results are to changes in the assumptions, initial conditions, or data that go into the model. Frankly, this is a major focus of most of our conversations about the projections on climate change, with much emphasis on the uncertainties and what we don't know, and little emphasis on all the things that we have learned and the generally robust conclusions of climate models. Economic forecasts don't receive the same scrutiny, and frankly, they often miss very significant changes. We've spilled blood and treasure over this commodity. As we all know, it still plays a major role in fueling our economy. We need to understand fully the implications before we make this change. I note in Administrator Saminsky's testimony, when he provides the results of EIA's latest short-term energy outlook, that he includes the disclaimer, of course, the recent dramatic declines in crude prices may affect our outlook in the coming months. So I would like to better understand how robust these benefit estimates provided in the studies referred to are likely to be. Dr. Eppinger paints a very positive picture resulting from lifting the crude oil export ban, reporting a gain in GDP over the next 25 years of $600 billion or billion to $1.8 trillion. That range is dependent upon which EIA scenario is used. These are model results based on other model results, EIA's model results. What are the assumptions, I would ask the panel, about the world price of oil in the underlying EIA scenarios, and how would changes in that world price impact those given estimates? Dr. or Honorable Saminsky, if you could, please.
Congressman, we will be looking at this, and we'll have a lot more to say, I think, when we publish the annual energy outlook early next year. I think what I could say is that lower oil prices, if they were to remain, will slow down this growth in U.S. oil production. I mean, that's supply and demand pricing. The other possible effect it could have is to make it less profitable for companies to export natural gas in the form of LNG from the United States. And the reason for that is exports of LNG from the U.S. generally are predicated on selling into a market where that gas in Europe or Asia is priced at an oil equivalent. And with lower oil prices, the spread or profitability of exporting U.S. LNG into the global markets would be reduced. And so that might change those dynamics a little bit. So there are going to be a lot of places, in our forecasts, I think, where building in a possibility that lower prices could stay for a while would have an impact, and we will have plenty to say about that in the coming months.
Thank you. Ms. Gordon, do you have anything to add to that?
If I could add, sir, if we look at past situations where we've had precipitous price declines, I think you can look at internationally and say that the price declines at some point become the engines of renewed growth, because the Chinas and Indias and Brazils of the world, all of a sudden, if they start seeing $50 oil, they start saying, let's rejuvenate some of our economies and rev up projects that didn't make sense at $100 oil. And remember that I think it was in '98 that the price of oil fell, I think, from 117, 118, something like that, down to $38 in 7 months. But it came rapidly back up. I believe, if I remember correctly, at least into the 70s, and then worked its way up to where it was before the current price drop. So, low oil prices for those countries that are huge oil importers and fast-growing populations we've talked about in Asia, low oil prices are a boom, and at some point it will rejuvenate the Chinese and Indian economies and bring, hopefully, the rest of the world along with it as demand for goods and services once again intensify.
Mr. Chair, I yield back. Time is up.